psyche of a venture capital investor's psyche, and try to turn the tables and make you think on what the VCs are thinking. Apart from valuation, there are lots of other things also involved in the venture capital, which you should be equally aware of. So this is a broader sort of outlook of the aspects that you need to be aware of if you were to explore venture capital as an avenue. So I'll just jump right in. So I'll just give you a quick introduction of who we are. So Avishkar Capital is actually a India-based venture capital firm. We started in very, very early days of venture capital, around 2001, 2002, with a slightly differentiated approach to venture capital investing. Most of the money was going towards technology at that time. We realized there are lots of wider essential problems which need to be solved by private sector entrepreneurs, and those kind of business models are not really attracting significant capital. So Avishkar Capital was found with a genesis that there are so many mass market issues which can be solved by private sector entrepreneurs in a very scalable and profitable way. And that's where the sectors of focus like sustainable agriculture, financial inclusion, and essential services came into play. And we started very slowly. We raised the first $1 million in 6 to 7 years. But once our startup started showing demonstration, the next leg of the journey was quite quick for us. As of now, we manage $400 million in assets across six funds, out of which 5 invest in India, 1 invests in other geographies like Sri Lanka, Bangladesh, Indonesia. We've been investing in Sri Lanka for the past 5 years. We've got 2 portfolio companies there. Our startups are heavily focused on the sustainable development goals. And they obviously have to demonstrate the venture capital investment return alongside the impact goal that they have. So there is a dual objective approach that we employ. Over time, we have invested in close to 61 startups. Out of those 61, we have exited 37. So one of the few fund managers who have seen the full life cycle of raising funds, deploying the funds, and securing exits. Right now in India, we are raising our next fund. This is going to be a $250 million fund, which is going to be up and running very soon. And we have a team based in Nairobi, which is also raising an Africa fund. So to that extent, we have taken this approach of impact venture capital from India to the world, including South Asia, Southeast Asia, East Africa, and starting from India. So this is a little bit about who we are so that you get a context of who is really speaking here. Moving on. Now I'll leave aside the impact investment side completely. I'm going to be primarily focused on venture capital as an instrument. What is it that venture capital equity investment mean? What does it mean to raise venture capital investment? So again, how we invest. So essentially a difference between debt and equity. You have to be very clear when you're speaking to a venture capital investor. Chances are they won't look for any collateral. It is a very high risk bet. They are becoming your partner. They are becoming your stakeholder. So a venture capital investor who invests in a company is buying equity shares. So they become an equal risk kind of a shareholder. So one thing you need to be very clear about is that the risk element is shared. The equity instrument should not have terms like significant coupon rates or significant interest rate, because that will be very detrimental to the whole logic of venture capital. So when you are raising this capital, you are giving them equity shares. Those equity shares will have certain rights, but you should definitely avoid anything like coupon rate or interest rate, because otherwise it becomes more like a debt rather than equity instrument. In terms of the valuation is discussed mutually between the entrepreneur and the venture capital fund. And this is where, a lot of confusion typically lies, because you see very early stage companies also raising capital for significant valuation. And that's where valuation becomes a bit of a combination of art and science. We will try to get into some examples as we progress. But please do understand that valuation is something which is actually a mutually decided, mutually negotiated value between the entrepreneur and venture capital fund, and it can have a significant variance on a case to case basis. But as an entrepreneur, your responsibility is to provide the maximum amount of comfort to a venture capital fund to maximize your chances of securing a good valuation and limiting your overall dilution in the company. And hence, many a times when you are talking to a VC fund, they will say that while we like the sector, while we like what you are aiming to do, it will be great if you can actually do some demonstration and come to us. And that is where different kind of capital at different stages play a differentiated kind of a role. So generally speaking, to the extent possible, if you have a demonstrated business model under your belt, you will be in the driver's seat on valuation. If you are only going on a paper plan or an idea, chances are your valuation negotiation will not be that easy. You may have to dilute a significant stake, and also the chances of that deal happening are that much lower, because unless the venture capital investor knows you on a personal level, knows the level of quality that you and your team brings to the table, it is highly unlikely that the VC investor will take a very aggressive bet on you. Even if they do, they will take a very conservative bet and they will end up taking a lot of stake in your company, which will be detrimental for you in the longer run. So it is always a good idea to first demonstrate, at least have a pilot ready, have all the elements of the business model demonstrated in some form or shape, and then approach a venture capital investor for the fundraise. How do we make money? So venture capital investors typically stay with a startup. Once I invest in a company, I stay with that startup from 4 to 7 years, typically in very outstanding or exceptional circumstances, we will exit in a couple of years time frame. But typically the holding period for a venture capital investor in a startup is anywhere between 4 to 7 years, because that is the time it generally takes for the startup to achieve some of these milestones and create value for itself and for its stakeholders, which in this case is the venture capital investor. The interests, once we are invested in a startup, the interests are completely aligned. If the company becomes successful, you as an entrepreneur will create value, and there will be value creation for you on a personal level, as well as value creation for VC as an investor or a stakeholder in the company. Hence, what we try to do is make this a partnership. You obviously as an entrepreneur have the executive responsibility of executing the business plan, and wherever we can provide you assistance in making your dream a reality, we try to do that. And I've also touched upon some of those areas going forward on what you should expect from the venture capital investor, why you should demand certain things from your venture capital investor beyond the capital, because ultimately you should be best equipped to be implementing this business plan going forward. And the state, and because there is no conflict of interest, the interest is completely aligned, it is in best interest that a venture capital investor and the promoter work like partners as the journey evolves over a period of time.
Great. Shashwat, before we go to the next slide, I think something that we've learned is because it's virtual, it's very hard to get the engagement and people kind of forget as we go down. I just want to give the opportunity very quickly for anyone who have any questions around that information that Shashwat just shared. If not, I would like to bring in Imal and Rishi just to add their perspective on the areas that was just covered. Any questions? You can unmute yourself and ask at this stage. Okay, since there are no questions from me, Imal, if you can just maybe rewind and go back to your first round. How did that negotiation happen? How did you, I think it was Dunamis, if I'm not mistaken, the initial investor. What was your process and how did you take the negotiations with them?
Yeah. So I think when I look back, the way we approached was exactly what was explained previously, where we started putting our own money into the company, what we have saved, and also there was certain debt capital we have raised. So we used that to build the product and acquire a few customers. Some of them were good, and then we went into the investor, right? So in that way, we had a credible story. Apart from we had a good product and a good team, so it was proven in the market. So we could negotiate higher valuation, and also the investor had reason to believe that these guys can execute because we have already shown some traction and the progress with real customers. That's the point number one. Point number two, like as any entrepreneur, we were also very, very ambitious. So I think we started with a valuation with Dinesh, asking like about $10 million valuation and $1 million, 2 million, 20%, $2 million. So he laughed off and that didn't happen. But then again, after about 6 months, so maybe a little more than that, he called us again. So we also have realized it's not going to work like that, right? So, but that time also we have progress. So his confidence level was also up. Our expectation were also kind of down, right? So we had the kind of right maturity level at that time, also the right timing for us to get that negotiation done. So again, it's like when it comes to valuation, it's like, you have your land, right? So, and it's the value that you want to sell and the value that the other guy want to buy. If the guy who is next door wants to buy that land, he will always pay a premium. Like if he really want to buy, then it's in his strategic investment direction, he will pay a premium to buy, right? So that's the kind of mindset you also need to understand. I would say negotiate well. I mean, not in a bad way, because if you're negotiating well with the investors, they'll also think while they will negotiate hard with you, they'll also realize later that this is the same guy going to negotiate a good deal for you in the next round, right? So I would say negotiate well, because that you are negotiating on behalf of the company. When it comes to company in the next round, it is that investor who's coming in as well, right? So it's not a bad thing if you do it right. So that's my 2 cents into the conversation.
Great, thanks, Imal.
Thanks, Imal. Very helpful. Kishan, you have anything to add here?
Do I have anything to add to Imal's?
I generally like it when the investor and the entrepreneur are sitting. So I just want you guys.
I think that negotiation was done when BOV came. Rishi was the one who headed that. So I think Rishi.
I see. Rishi can add flavor to that.
So no, that's interesting. Actually, I remember the day. I actually flew down, and Rajan and I spoke, and he said, "Hey, Rishi, can you go down to Sri Lanka?" I said, "Why? What happening?" He says, "There's this really smart entrepreneur, who's been in the industry and has got a venture, and I'd like, why don't we look at this?" And so I flew down and actually spent 2 days with Imal and his team, as well. We went down into some of his customers. But I want to stick to the point on valuation, and I think I completely echo what Imal said. You need to negotiate; it's important. And I think, Shashwat, you set up a very good foundation. see, there has to be a basis, right, of any value. And that basis of that value, if you establish the basis with, with some key elements like market, opportunity, what is the value proposition, then there is a starting point. After that starting point, if I may just add one other additional point, is that, you've got to be storytellers. So I've been dealing with Sri Lanka now for about 6-7 years. I must tell you this, that Iman is a very good storyteller. Okay. So that's why he's one of the most successful entrepreneurs that I've seen out of Sri Lanka. And again, since I live in India, and Shashwat, you know this as well, a lot of companies in India, if you see the difference in valuation, is purely because, some are better storytellers than the others. And so don't be shy. When you are an entrepreneur, you typically are the person in the room who knows the most about that opportunity. And if you're not, then frankly, you won't get funded anyway. But I'm assuming if you set up a venture and you're looking for funding, so you know enough about it. So prepare to tell the story, show the passion, how it works. I still remember, Imal did a very smart thing. He sent me to one of his best customers in the hinterlands, MAS, and he set up a meeting for me with the general manager of that manufacturing unit, who actually sold Ensinga to me. So Imal didn't have to sell Ensinga to me, because the general manager of that factory of MAS plant said, Rishi, we are saving so much money using the Ensinga product. So these are some of the things, as I think Shashwat, you said, it's not a science, it's an art and science. And I think I just echo the same comment. Don't be shy. It is a process. You will start off with an A number, and then it'll settle somewhere between that number and the number that you're able to justify with the other side. And finally, of course, it's also demand supply, folks. If you are in an industry which is growing very rapidly, and there are other elements in that industry which have had reasonably good valuations, you have a better chance to be able to tell that story than not. So yeah, those are my few thoughts. Back to you.
So Shashwat, to your question, I think I had the unique opportunity to be on both Dunamis and BOV Capital side, with this Ensinga deal. So I remember, first time dealing with Imal, right? I mean, when Dunamis was ready to fund, I realized, okay, this guy is a hard negotiator, right? And obviously, we also didn't want to give in too much. But at the same time, what Imal pointed out, that was also something that we really thought about, where, he said, if this guy is negotiating so hard right now, then, we were quite certain that he's going to, do the same thing in the follow-on future rounds. And I think he did exactly the same with BOV. And I was not part of BOV at that time, so I realized, Imal had cut a good deal with BOV.
Awesome.
So yeah.
Fantastic. Awesome.
One more thing I want to add, if I may. The location of where you're raising fund also matters, right? So while we were all, based out of Sri Lanka, we set up the company in Singapore, and we always try to benchmark our valuations against the Singapore ecosystem valuations. Probably it was 3 times higher in any given situation. If you compare apple to apple, that was my experience. Maybe Shashwat and Rishi had better experience on telling what what is that ratio. The other thing is to the point, like in the final exit happened, I remember, when I was negotiating, the first offer was at $10 million, and at that time some of the investors were said, okay, take it, right? And the second offer was at 12. Then most of them said, okay, let's take it, let's close it. I said no, right? And then there was at 14. We said no, and then I think at that point I also thought the deal is gone, because there were no communication for about 2-3 weeks. And then we wanted to close it at 15, so we started at 25, and we knew that we come to 15, we close it. So when there's no news after the offer of 14, I thought they have walked away. All these offers came in they took me to F1 in Singapore, and with that glamour and all that, they throw in the those term sheets in the backdrop of F1, all the parties and all that. I was drunk, but I never came in. I was still aware, right? So the funniest thing is, like, when on the final meeting, I went on with Ankiti. I knew that this is the last chance, so I'm going to handshake at 15, right? So we went in with, again, come down from 25 to 18, and then we handshook at 15, right? Again, as Rishi said, we had the number to back it up, like very clear down to, okay, why it is that, right? What is our price points we sell, how many factories in a factory, how many lines, how many factories in each country, how much money we can save if we increase quality by this much, productivity by this much, and how it can impact the valuation of Selingo. We were well prepared. Apart from we are negotiating hard, we had the facts, numbers to the nth degree. I mean, no one could drill us down on that and say it is wrong, right? So it was so logical, right? It was so logical. And then the final piece, after we close it at 15, they brought in this set of lawyers, Cooley, like from US, the Sequoia lawyers, and they throw in a contract. And in that contract, there was a clause, 15 million, the valuation, whatever agreed, is the enterprise value, right? So we were also so thorough. I mean, I had this knack during my enterprise days also. I read contracts, and I try to pick the commercial points on the contract. So enterprise value is 15 million. So that means without the cash, they thought like we may have debt so payable, so that they put that to say 15 million, they could bring down to 14 million. That was the strategy. They thought like we had. So I knew where it was coming from. We agreed to that clause, came back, put the entire company to do the collections and get the invoicing done. By the time contract was running, they had to pay 15.5 million. So 15 million also stretched to another 0.5, right? So that's how we did it. So again, like, it's not only the negotiation, but also certain clauses in the contract can bring your value up or down, depending on how well you have run the business.
What a story. Fantastic.
Fantastic insights.
Thanks, Himal. Very, very
Thank
personal
you.
and I think very helpful for the audience here. So as I think Himal has pretty much covered the whole life cycle here, right from his early days, how he decided on dating with the venture capital investors, and making sure that, this is a bit of you playing scarce, you showing that scarcity premium and yet not breaking the bridges. So that's what Himal actually demonstrated. He obviously kept in touch. He kept demonstrating. He made sure that he is implementing on the background so that his case of negotiation becomes even more solid as the time progresses. And then at the right time, they were able to handshake on the deal. And later on, when the exit negotiations were happening, he was very clear that he doesn't want to sell himself short because this is his life's work. So he stood his ground, he gauged how the counterparty was, and eventually negotiated a price which was brilliant for himself as well as for his shareholders. So this was a very interesting, personalized story, which will give you a sense of what it takes to actually go through this entire cycle of raising funds and returning funds as an entrepreneur, and also realizing value with the scale up of the startup. So this chart is actually pretty much covered by Himal here. Initially, Himal took that journey of bootstrapping and taking some money for family and friends and demonstrating to a certain level, after which he was ready for venture capital investment. At that time, he negotiated, he brought in a case for himself why he should command a certain amount of valuation. He did a handshake on the basis of that. After that, he focused on growth, He demonstrated in multiple markets, not just Sri Lanka, but outside Sri Lanka. And at the right time, he engaged with strategic parties in Singapore to actually close out the exit transaction. So this is the full life cycle right in front of you. Initially, you should try and make sure that demonstration is done through your close contacts, people who trust you, because even VCs like to see, are there people in close circles, close personal circles of yours who are willing to bet on you? Because that is the first venture capital money or venture capital like money you will find. Are your friends willing to trust you? Are your ex bosses willing to trust you with their money? Even if they are putting small amounts, but them putting in equity capital in you is a demonstration in front of the next round of investors that people who are in close circles of this particular individual are willing to put risk capital, and they believe in this individual's capability and this individual's capability to demonstrate on the business plan. Once you have a proof of concept ready, once you have a few of the clients already paying clients onboarded, at that juncture you can go on to an angel investor, or you can straight away go on to the venture capital investor depending on what kind of scale you have achieved. On that, there is no formula per se. Nobody will tell you that you need to have at least $1 million revenue or $500,000 revenue to approach venture capital investor. The VC investments can actually happen at sub $500,000 revenue also, especially in a Sri Lankan context, and can also happen at a $2-3 million kind of a scale as well. There's no formula to it. Depends on what area, as Rishi pointed out, what area are you operating in? Is it a very hot area? You are seeing good month on month kind of a progress. Then a VC investor can actually come in early as well. But generally speaking, the more and more revenues or the more and more clients you have under your belt, your negotiation power will be that much higher. Once the venture capital investor comes in, after that, you will have a private equity market to tap in. Private equity guys primarily require your financial ratios to be in place. You need to be profitable. You need to have a return on equity, a demonstration under your belt, and they use public market kind of comparables to value you. So private equity valuation negotiations are very, very range bound. They become more tight in terms of negotiation, and ultimately, for providing exit to all the stakeholders, you can actually go and get listed. Colombo Stock Exchange is seeing rampant action these days. This year itself, it is expected that almost 13 to 14 IPOs on Colombo Stock Exchange would have happened of different scales and sizes. So this is the whole journey of a startup. Imal has very nicely captured the bit that you have to continuously focus on demonstration, on the ground demonstration of the business model, and concurrently maintaining touch with the venture capital investors and hitting the chord at the right time. Moving on to the next one.
Shashwat, if I may add,
Sure.
add here a little bit, I mean, trying to, if you go back to the slide, I will try to draw parallel and give some examples and stories. So bootstrap, yes, we put our own money, and I would say in our case, the angel investor was Dunamis, Dinesh, right? So, and that time, Kishan was also there, right? So Kishan was always our supporter with Dunamis as well as in BOV. And as an angel investor, when Dunamis gave us money, it was not even on a proper contract, like, it was 100% on trust, where we had Ashok, one of our co-founding partners, and then he was MBA alumni with Dinesh in INSEAD. That's how that connect was, right? So that was known contact. So he had the trust, and then from there, Kishan joined, and then Kishan introduced us to BOV Capital. But while Dunamis could get us the money, we wanted to build the product to the next level and go to another country. We believe we need a partner like BOV who could help us scale internationally as well. Where that is where we saw the value of people like Rishi coming and helping us open up markets like, in India. It was never was in our plan. He and Kishan pushed me to go in there, and it was probably the second successful market after Bangladesh we had, and it was a complete surprise, and it wouldn't have happened without them. So and also they brought in other co-investors like Singapore Angel Network, right? So, and they are the ones introduced us to Zelingo, who eventually bought us. And then when that happens, Sequoia was, also their investors. So I'm sure there is some, comfort in there as well, because these are all known in the ecosystem. So it's important that you bring in the right investors also at the right time for certain, because even if I would have taken follow-on money from probably another Sri Lankan only kind of investor, we wouldn't have made it probably, right? Because it was also, you need to make sure you bring in the right people who you can take it to the different markets and have that kind of exposure and experience to do that, right? So that was also played very well in our case. Just that who you take money and whether they are aligned to what you really want to do as a company, that also matters.
If I may just add, Shashwat, on that point, actually, I think Imal hit the nail on the head. Is it okay, Shashwat, if I just spend like 30 seconds on this? So while the discussion today is on valuation, remember, valuation is a combination of many things, as Shashwat has already shown, right? And the point that Imal just made, and I have myself been a founder. I'm a founder of a deep tech, battery energy storage company out of IIT Kanpur in India. And I'll tell you this, we are, while pitching to investors, while there was a lot of money people wanted to put into us, the number one reason on which we actually took the money in the company was, what strategic value does the investor bring? Because if you're only raising for cash, then, as a founder, you will struggle, because, sometimes when you get the money after that, it's even harder because you got to execute now, right? And for execution, you need help. So it's always good to, while you're negotiating the valuation, you're looking at the quality of investor. You also look at which investor works best for you to grow your business from 0 to 1. Because especially in an early stage, you want to ensure that you survive for the first 3 to 5 years. If you survive for 3 to 5 years, chances are you will thrive in 5 to 7 years. And that's really the time frame. So I think, Imal, great point in terms of, and I appreciate the fact that you recognize, BOE, but I can tell you this, there are many investors in the market who bring only money, who will sign a check. And there are some investors in the market who will sign a check, but will also bring a lot of strategic value. And I think Shashwat mentioned that for Avishkar as well, right? It's not only about investing, and putting some dollars or rupees into the hands of entrepreneurs. So this is a very important aspect. So to give you an example, if somebody gives you a higher valuation, but is not strategic, and somebody who's strategic gives you a slightly lower valuation, you need to take a call. Because valuation is always an outcome. It cannot be the starting point, because it's a negotiation, as Shashwat and Imal suggested. So this is a big factor that that I believe plays the role in the long-term success of a startup as well. Back to you, Shashwat. Thank you for that.
Oh, very, very valid points, Rishi and Imal. Thanks a lot for that. In fact, with Avishkar also, if I can take an example, we have, as I mentioned, we have 61 startups spread across multiple geographies. And there are certain pockets of concentration. For example, in microfinance, we were among the pioneers in the country. So we have about 15 microfinance companies spread across all states of India. So any startup who is into financial inclusion values that, because we have seen that journey of creating very rural last mile financial inclusion ventures right from seed to IPO on so many different occasions, that we bring connects as well as experience of bringing things forward. So you will naturally find some of the sweet spots for every investor. In Sri Lanka, clearly, if you are a tech entrepreneur, then BOV Capital has that top of the mind recall. They've seen that journey of creating a tech from a very formative stage, taking it to markets outside Sri Lanka and scaling them. So you are better off, partnering with a partner like BOV Capital. Similarly, Sequoia is a global name, right? If you're a tech entrepreneur, Sequoia is a very tangible name because they've seen, products across a very wide set of spectrum, and seen all the kinds of challenges which the startups come across and have navigated it alongside the entrepreneurs. So those kind of strategic values you should definitely evaluate, and hence your research needs to be thorough. When you're approaching the market, please don't do a blanket approach of going to anyone and everyone. Please try to make a focused effort of identifying the 5 7 guys who need to be your top of the list, and you need to have the reasons very clear on why you want to partner with them. And when you are negotiating with them, do bring up those points so that it's very clear that this is the kind of partnership we are envisaging when we are partnering with. So just moving on to the next one. So I'll not spend too much time on it because this is pretty intuitive. What do VCs look for? We look for a massive opportunity. Market size needs to be very, very significant. Now, this is very important. You guys are Sri Lankan entrepreneurs. You know that, it's a relatively small country. What kind of business model are you bringing that can have an appeal for a VC as well as for yourself? Even if you take the VC out of the equation, is your targetable market size going into tens of millions or hundreds of millions or a billion? That's a question you should always have in your mind. And you should have a very clear idea of your target segment, their paying capacity, and your business models, geographical contour to establish how large a market opportunity you are looking at. Second thing, it generally is the first thing as well, is the promoter and the team. Who is the founder? What kind of team has that founder been able to attract with the limited resources that founder has? And the third is the business model, because typically what happens is business model keeps on pivoting slightly, especially in the formative days. In the first 2 3 years, there are plenty of iterations entrepreneurs go through. So chances are the year 0 business plan will be very different from year 2 business plan. And I'll bring Imal also in. I'm sure he would have seen that journey of what kind of clientele he had to target, how he decided on his pricing, how he decided on his service delivery, everything. Year 0 versus year 1 versus year 2, it keeps on evolving. And venture capital investor as a partner will sit with you and understand the market reality and try to make sure that the direction of the startup is fit and proper. And finally, exitability, because ultimately we are going to sit with you for 4 to 5 to 6 years at best. So we need to make sure that we need to have some narrative that if this startup goes big, then who are the market participants who will value this startup and who would want to partner with this startup in the next leg of their journey. Those partnerships will lead to an exit of a venture capital investor. So whenever we are going into a startup, we need to have a thesis that once this startup scales up, there is at least a 4 or 5 people list right there at the top of the mind who will definitely value it for ABC reasons. So that exit thesis is something that the venture capital investor typically tries to bring through for sure when they're entering the startup. Any pointers, guys, on this slide? Rishi, Kishan, Imal, anything from your side?
Yeah. So as a entrepreneur, if you are a first-time entrepreneur, right? So you may have experience, but if you're a first-time entrepreneur, my advice is if you have a exit offer on the table, if it's decent, take that first decent offer, complete the cycle of being an entrepreneur, raising funds, scaling, and exiting. Then after that, the kind of credibility you have, because there are a lot of entrepreneurs, there are a lot of people raise funds, increase valuation, but there's only very few had made exits, right? So you probably have opportunity to go on and make it bigger, but you never know. Now in our case, like we exited at December 2019, right? And then Feb 2020 COVID started, and we would have struggled if you would have said that, rest is history. So first good offer, please consider it seriously, because if you are an entrepreneur once, you can be entrepreneur twice or whatever, but you will have a bigger credibility in the market to do bigger things. So that's my advice on the exitability on that. The other thing is, again, when you're building, don't build to exit. Like, when you do, of course you have to have exit in the mind, but it should not be always, okay, how do I exit? Should not be the kind of thing in your mind, right? How do I build a good product? How do I satisfy my customers? How do I keep my team together? How do I attract the best people? How do I build a brand? That should be the day in and day out thing. Exit is not the day in and day out thing. You build to last. You're not building to sell or exit. But of course, when that offer comes, if the offer is good, take it, right? Don't think that I can, but if you have done it like once or twice, and if you really believe that it can go bigger, then probably it's a different story. That's how I thought, right? So that's what my thinking is. My thinking was when I did the first exit. So there's a lot of weight off your shoulder, right? Because now you have completed the cycle.
Great points. So,
Shashwat, can I ask you a question?
Sure.
Relating to this slide. Obviously valuation is a trade-off between risk and return, right? Now obviously you have invested in India, in Sri Lanka, and I know you're investing in other parts of the world as well. What do you look at different stages of the startup when you really look at this risk return sort of, balance? Obviously, when you're an early stage, your risk comes from areas that like team and etc. But as long as the startup progresses, that sort of team risk maybe goes down and some other risk comes up, right? So how do you look at risk return?
Sure. So, Kishan, I think for us, we have actually got the good fortune of straddling across very early stage to early growth kind of venture capital investments. In a very early stage kind of scenario, what we have realized is the only thing that has mitigated our risk is the team, and that's where the pillar number 2 mentioned in this slide becomes the foremost thing, because we believe great individuals can create great companies, and they figure out a way, and hence we try to put pillar number 3 a little bit on the back burner, except that the sector will be decided, the target segment will be decided, and the startup goes and attacks that problem. And the way we try to mitigate our risk is that we do not become very aggressive on valuations in certain cases. In such cases, when it's a very early stage startup, we end up with a very sizable stake in such cases, and that kind of allays some of the risk, especially the financial return risk. And at that juncture, it becomes very important that we also try to do a soft sounding to some of the later stage investors on this particular sector, this particular concept. Is it palatable to them? Is it matching their strategy? Would they like to invest in this firm provided this firm reaches $10 million in revenues or $15 million in revenue? So some market recce we also do while we are entering this very early stage deals. So these are some of the levers we use to mitigate our risks. When the startup actually has significant demonstration under its belt, at that time we believe that the role shifts slightly. We try to make sure that can we create a syndication right up front? Can we create a syndicate of investors rather than us coming in solo, so that the funding, the funding resources available to the startup are that much wider. It should not happen that just Avishkar needs to support them. Avishkar plus 2-3 other funds come in together, then they will be sorted for the next couple of rounds, and the trajectory will be different. So in a more later stage kind of a concept, we have seen syndication as one of the tools which gets used so that the startups growth capital requirements continue to be met.
When you say syndication, Shashwat, you're saying that is to sort of spread your risk, right?
Yeah,
your
so for
journey?
example, let's say a agri-tech startup comes to me, which has some level of demonstration. Agri experience is very deep in Avishkar, but on the
Yeah.
technology side, we partner with 3, 4 venture capital funds on the tech side, and we try to sound them the concept, and we say that, hey, this is a $10 million round. Why don't you do five? I'll put in five, and let's try to make sure that this startup is sorted for the next couple of years. At least one round we will continue supporting, and once it scales from 10 million to 50 million, 60 million, at that time we will jointly try to find an exit for ourselves. So the syndication, I mean, is basically we try to find complementary kind of investors who can also support this startup alongside us, and then the startup will have access to not just Avishkar's pool of capital, but also some of the other guys, and also the
Yeah,
skill sets.
and it also works both ways, right? I mean, for the investor, you sort of spread your risk
Yeah,
because now there's more other investors. For
absolutely.
the startup, I mean, you now have all the elements that you want from not
Exactly.
one investor, but you have all these different investors who bring different skill set, right?
Absolutely.
Yeah.
Absolutely.
So I think so I know in Sri Lanka we are trying to do more syndicate deals, but since it's just one or two firms
Sure.
right now operating, I think syndicate deals are not out there as much as we would want. But yeah, I think that's a great point. I think because I sort of raised that question because many of the startups today in this forum early stage, right? So obviously they will, when they start valuing and when they start having negotiations, I think what I would want them to know is what is really critical. Also it depends on where the stage they're at, right? And the risk sort of changes in different stages.
Sure. Sure. Sure.
I think we have a question from Camilla. Camilla, you want to ask your question?
Yeah, hi. This question is to Imal. Hi, Imal. This is Kamila here.
Yeah, how are you?
Hey, how are you, man? So my question is, Imal, right? I'm asking this because I don't know how long you will stay in the program, so that I wanted to just quickly get this question across. It might be too early, but apologize in front. So my question for you is, like, we know that in a valuation, the traction, the market, the team plays a major part, right? But in your valuation, what were the things that surprised you that had an impact on your valuation? Rather, I mean, everybody, if you go, I mean, things you go through, those things are considered, but what were the things that came into play that actually surprised you that impacted the valuation?
Yeah, it is a good question, Kamila. I think probably someone like Rishi can help me. Like one of the surprises is how a team play a role, right? Where that we realize investors didn't tell us early days that they invest because we were a good experienced team, right? Because they always want to keep you also toes, so you don't hear a lot of praises early days. So something that we realized, we had an experienced team, like who. So those were the things that gave them a comfort to give us those kind of valuation, because we had all the ingredients apart from the product, apart from the market, we also could sell, and the team was good, right? So that was one of the factors. And when it comes to exit, again, like, so we were like product company, SaaS company, we were raising money at 10x of valuations, but we got bigger 10x of revenue kind of valuations, but bigger this thing came in when we were doing exit, because this were a company who was seeing a strategic fit, where we were a kind of important missing piece of their whole story. So we were building on the factory, connecting factories and making factories more intelligent, and to improve, on-time delivery to quality to efficiency and all that. So the bottom line, but for them, it was a bigger part of their story, where they were all connected on the consumer end to B2 marketplaces, fintech, financing the suppliers, all that. But they had the piece on getting insight from the factories, right? So again, that's what I said in the beginning, that you are that next land plot next to your house, where for you to expand, you really need that, right? So if the perch value is 5 lakh, you probably will pay 7, 8, 9, even 10 lakh to get it, because if someone comes and build a house there, you are gone, right? You can't expand from there, right? So that was a surprising factor for us. If you ask me, apart from what I explained, which is probably pretty generic, probably Rishi can add here from the investor's point of view.
No, actually, I think you nailed it. So Camilla, if I was to just say 3 things that drive valuation, the number one is the entrepreneur themselves. It's a very, very high weightage. So as an investor, when we, for example, in an early stage investment, when you're raising your early stage investment, the only thing that that is the real deal maker is the fact that do you believe this entrepreneur and his co-founding team will be able to deliver the goods? Because remember, Shashwat said that when we make an investment as a VC, our time horizon is anything between 5 to 7 years. Now, so you have to make a bet as an investor that can Imal and his team, Vijay and others, are they the people who can actually, see, it's easy to write plans sometimes, okay? To build a slide, it's not very hard. To get ideas is not very hard. To execute is hard. And the execution piece is directly proportional to the entrepreneur. So that's the number one thing. Number 2 thing is traction. See, traction proves to you that there is an idea and there is some, somebody who's willing to pay for that idea. Traction basically means, are there any customers? Are you solving a big problem? And you get, when that gets validated, that's an added layer. So first is founders. Clearly, we bet, I mean, at BOV, we say this very often, that we bet founders. We don't bet technology. We invest in technology companies, but we bet on founders. And the third element, which again, Amal talked about, is for an exit of a company. There are many elements that come in, but again, in an exit, I'll tell you this, that they look at, how additive is the value of the company that I buy. So I'll give you an example in Nsinga. I don't think Imal is very, I think Imal is very humble. He hasn't told you this, but, after Nsinga got acquired, they very quickly, Zilingo was able to expand to 4,000 lines in factories. 4,000 lines in factories. They could do it within the first 1.5 years, a year, I think, which they couldn't have done if they had tried to build the business themselves. So if Zilingo bought Nsinga, they spent $15.5 million buying Nsinga. They could have spent that same money to build. It would have taken them 3 to 5 years, right? So and they also acquired a team which included people like Imal and Vijay as the co-founders, who could run the boat very quickly and add value. So, when somebody acquires a company as an exit, one of the ways they look at it is that if I spend 15 million, how quickly can I recover my 15 million and grow the business? So for Zilingo, by growing the business in 1.5 years, they more than adequately recovered what they paid for Nsinga. So that drives the value. But I think if there's one thing, it's the entrepreneur, it's the founders. How good are they? I think that drives valuation.
Right. Thank you very much, gentlemen.
Thank you, Kamila. Yeah, back to you, Shashwat. I think there's no other question.
Kamila and I used to work together. We used to play as well. Right?
Yeah, we go back for Millennium days.
Yeah.
Oh,
Kamila was the best basketball player we had in our team. Right.
Yeah, so now he's applied through Venture Engine. We'll see where that. Anyway, I know he has some news, but I don't want to mention.
Right.
Some other stuff. Thanks, Kamila. Yeah, Shashwat, back to you.
Yeah, I'll just swiftly move from here. I think a lot of points are getting covered because Imal and Rishi are pitching in with very pertinent points. So my job is very easy. What do VCs offer? Mentoring, strategic guidance, operational guidance, and this is all not very conceptual, not very difficult to actually understand. If you go to if you're doing a research on a VC, you should first go visit their website. What kind of work have they done in the past? You should talk to some of the founders that they have backed. What has the experience been? So you will get a flavor of what this VC is good at. Is he good at connecting with people? Is he good at brainstorming? There are lots of different facets they bring to the table. There are some VCs who are extremely good at creating the digital marketing aspect to early stage startups. There are some VCs who are very financially prudent. So there are different facets that you would require you should research, you should try and understand, you should talk to as many people as possible. Before you start interacting with a VC, you should have some thesis in your mind that why this VC will probably be the right VC for you. As Imal pointed out, when he had to step out of the country, he was looking for VCs who have those international connects. And that's when they ended up, raising capital from BOV Capital, which obviously has that India, Sri Lanka, as well as Singapore connect. So that kind of brought that regional connect for them to step out. The moment they stepped out, then the whole addressable market for Nsinga changed dramatically, and then rest is history. So these are very strategic discussions that you should take after careful thought. And VCs also appreciate, if you have really researched about them, they appreciate the fact that this entrepreneur is very rigorous in in its approach, and that kind of goes both ways. You know better about them, as well as they get satisfied that this entrepreneur is very thorough. Fundraising is a very critical piece where any VC will help you, because if you don't raise funds, your growth will get subdued. If your growth will get subdued, the value realization will not happen. So one of the most important elements where the VCs will help you for sure is the fundraising element. Not to say that you don't have to do anything after that, you will still have to lead the show. But VCs have that experience on what kind of pitches work for what kind of investors. So those kind of strategic inputs will go a long way, because VCs have their friends all across. They keep bouncing off ideas to each other. So those direct connects, those referrals work much better than a cold call to another different VC for a fundraising effort. So fundraising remains one of the most vital pieces of value addition that you will get from a VC. That's one of the areas where VCs differentiate themselves compared to an individual investor or an angel investor, because the breadth of network that the VCs have is generally very high. And finally, the networks and connections, which is a usual thing, because the VCs are your partners. Your journey, if it gets assisted through their networks, they will be more than happy to connect you to people. So just moving on quickly, what drives us? We obviously have expectations of returns. VC is a very high risk bet. So if a debt investor earns 10%, 11%, 12%, VCs cannot earn that. They are putting very high risk capital in you. So their expectation of returns will be upwards of 25%, 30% annualized kind of returns. What that does is obviously that you have to be a very fast growing startup. If you are not a fast growing startup, if you are a 10% year on year kind of a growth startup, you will never be able to deliver that 30% kind of a return to an investor, no matter what entry valuation that investor gets into. So it becomes absolutely important that the business model has that potential of firing growth in a very, very differentiated way. And hence, not every startup is VC investable. While every startup can be sustainable, can potentially exist with different sources of capital, but there are very few startups which are able to attract venture capital investment, because very few fit that bill of hyper growth that VCs require to deliver the kind of returns they are looking for. And the VCs obviously are the VCs typically have a closed-ended fund, so they raise capital and they have to return that capital within a defined time frame. The time that the VCs typically have is anywhere between 5 to 7 to 10 years. There are different kinds of funds all around, but typically 7 to 10 years is the sweet spot. They raise money from different sources. There are pension funds, there are insurance companies, high net worth individuals, development institutions, corporates. There are lots of different sources of capital from which VCs raise money, and then they have to return the money along with the returns in the 7-year to 10-year time frame. And hence the clock gets ticking. The moment a VC bets on you, it tries to create that whole growth journey in the first 4 or 5 years, so that there is a timed exit to it. So that's why in VC contracts you will realize they will put a time frame. They will say that I'm entering in your company, but I want to exit in 4 years, or I want to exit in 5 years. And if 5 years doesn't happen, then I will take rights so that I will somehow get my exit. They will try to make sure, and that's where the other terms come in picture. So many of these VC contracts, you'll realize beyond valuation, there are other things which the VCs try to introduce because they have to make sure that the exit from your startup happens in a defined time frame. You want to add anything, Kishan, to this?
Yeah, actually, Shashwat, on your point number 2, high risk equals high return, and then also investor return expectations. I think you covered, that investors in VC space expect a very high return. We had a conversation yesterday, me and Rishi, so I think I want to bring Rishi in here. Rishi, can you, I know we had this conversation yesterday about why VCs are looking for these large returns, right? I mean, I know it puts a lot of pressure on founders, but there is a reason behind why investors expect, especially VC investors expect high returns. Your thoughts, Rishi?
Yeah, sure. So, I think this is a good question because I think as founders, you should be aware that what is driving your investors, what is the motivation of your investors to expect a return, as Shashwat mentioned, right, of a high return. Well, it's very simple. The math here is very simple, folks. So as a VC, when we make early stage investments, or rather even mid-stage investments, the real data is that if you see for the last couple of years, in South Asia, 64% of the investments that were made actually don't even return the money that you invested. So, for example, if I invested 100 rupees in the last couple of years, 64 rupees out of that 100 rupees, I will never get back. I may get back 30, I may get back 40, I may get back 50, I may get back only 20, but I won't get back even the 64. So basically, it's a loss. So 64% of these bets don't necessarily make a return. Then you have about another 24%. So 64 plus 24, that's 88%, right? Another 24% of the bets will return about 1x, which means if I invested 100 rupees, I will get 100 rupees back. So I will get my money back, but no interest. And that money back is also over a long period of time, between 3 to 7 years, right? 4 to 7 years. And the rest of it, which is 12%, it's the 12% of the investments that we make as VCs. Those give us returns greater than 5x of what we invested. So supposing I invested 100 rupees, I have a chance to get back 500 rupees from those 12. So just to simplify the math, if there were 100 bets that we took as a VC, 64 bets I'm going to write off. I'm going to lose money on that. Another 24 bets, I will just get back what I put in there. So there's no return, there's no profit for the effort. And only on the final 12 out of the 100 companies that I invest in, I have a chance. There is no guarantee. I have a chance to recover more than 5 times my money. So if you do this math, it basically becomes imperative for a VC to expect, a 30% IRR or a 25% IRR at the very minimum while taking the bet with you. So when you are pitching to a VC, you should be clear that you will be able to meet that bar. Otherwise, the VC may or may not tell you, but he will not invest in you.
Very valid point. I hope that is clear. The math that Rishi explained, that this is not a sure shot bet, guys. Everybody works so that all the bets work, but it doesn't work like that, because at the end of the day, these are early, risky ventures. Lots of things can go wrong, and they do go wrong. There is a lot of leap of faith involved when these partnerships are happening, and there is a significant portion of capital which actually never comes back. So hence, every evaluation that is done on a yardstick which is slightly higher compared, so to factor in for all those losses, and that's why the venture capital investable businesses is a small subset of the wider startup bracket or growth stage company bracket who can potentially deliver that kind of returns. So that's the whole logic of expecting very high returns, so that on an average you can make that 15% or 17% kind of return at the minimum.
Sorry, Shashwat, Himesh here. Quick question.
Yeah.
Did you say the expected return IRR is 25 to 30%? Is that the benchmark when you evaluate?
Every startup, this is the bare minimum that people look for. But in very early stage proposals, you will even see 60, 70% IRR expectations as well. So it depends on which startup I am looking at. If I'm looking at a very early stage proposal, I can even look at a 60%, 50% IRR for myself. But it's a very high risk proposition. It can go to zero as well. So I have that probability built in that this can go to zero, but if it fires, it can really fire 50% kind of IRR as well.
Okay.
Yeah. So if you go back to that point number 2, Himesh, high risk equals high return, right? So it's the risk return sort of balance that investors look at. So early stage, the risk is high, so the expectation of return is also very, very high. So yeah.
Also differs from sector to sector, right? Like for example, if it's a tech or a deep tech startup, of course, there's chances of astronomical growth there. So the expectations of IRR are definitely much higher there. But on the other hand, if it's, let's say, a consumer food startup, the growth percentages are relatively lower. So the IRR expectations are also relatively lower.
Yeah.
Thank you. So what I was getting at was, is there like a window of criteria for each investor? So if it falls into this range only, I should be looking at these VCs. So is there, like for example, the ticket size? So it's a clear cut, which investors to go to based on the ticket size. But on the returns, is there like a window that each investor has said this is our criteria window?
So I'll tell you practically, Himesh, how it actually works. So let's say you go to a VC and let's say you're running a tech venture, and that tech venture is say $250,000 in revenue, let's say hypothetically. And you go with the business plan that I am very confident in 4 years time frame, this $250,000 will become, let's say, $10 million. The VC will look at your traction, your team, and so on, and try to do a very, very conservative assessment of that. And they'll probably try to beat it down to, say, 10 million goes down to 5 million. And they will then look at the 5 million revenue startups in that area and say that this 5 million, this area, let's say it's an enterprise startup, enterprise tech startup, there the multiples are reasonably high. It can go from 7x to 10x. So the VC will then say that, okay, 4 or 5 years down the line, even after applying as much pragmatism as I can, this startup seems to be valued around $35 to $50 million. So if I enter at say $10 million, I still have a hope of making 3.5 to 4x return in a 4-year time frame. That is the kind of thought process which is broadly there when there is an early stage kind of opportunity. And then you can reverse calculate. If you're making say 3.5x in 3 years, you are certainly above the 25-30% kind of a bar, right? So that is the way people typically think about these things. No VC will take your plan at the face value. They will do their set of evaluations. They will try to come up with a very, very conservative estimate that come what may, this is the number this startup will certainly hit. If it hits that number, this is the valuation that this startup may command 4 or 5 years down the line. And then they try to bring it back to see, how much returns can they potentially make. Rishi, you want to add anything on that?
So is that 4x, 5x
Yeah, I mean, if generally speaking, it's okay. I mean, if you, even with a conservative estimation, you can show a 4 or 5x. Generally speaking, yes, it should be workable.
Okay, thank you.
Thanks, Himesh. Thanks, Shashwat. I think Rishi will be dropping off, and we would like to take a picture. I think this has been a fantastic session. Shashwat, if I'm not mistaken, you might have to stop sharing. And I would also like
Shalinda, I will also have to drop
out.
Next
Okay,
5 minutes. So, yeah.
Super. If everyone can switch on their videos for a very quick photograph. I think we are also recording this session as well, so people can go back, listen to it. I think there's a lot of methods that useful. Just wanna couple of seconds, very quickly. It's okay. We understand the backgrounds are messy. That's all good. It's all accepted in this pandemic right now. I have 2 screens. Wow, okay. I have to take 2 pictures. All right, still waiting on a few. Nishadi, Prasanna, Sanka, Urmila, Hareen, Madhura, Ivan. I'm going to take the picture because I don't want to take too much time. So, 1, 2, 3. Hold on, I need to take 1 more. Again, I'll give a countdown. 1, 2, 3. All right, thanks. Before Rishi and Imal step out, I would like to invite Rishi. First of all, any last remarks that you want to share, especially from an early stage. If you really look at our group that we have today, these are all early stage, entrepreneurs. They're raising their first check. Most likely they will start off as a angel fund as well.
Suddenly there is some background noise. I don't know if others are getting it as well.
Yeah, there's some background noise, guys.
There you go. That's good. Now you're muted.
I hope that was not from me. I just
I'm also not sure. Yeah, now it's fine. It's gone.
Okay,
Yeah,
super.
Good.
So Rishi, just want to, just the parting remarks for early stage founders, when you don't have a lot of traction, especially on the valuation side of it, especially since you have also worked quite heavily hands-on in Sri Lanka as well, and you do have an understanding. What would be some tips for the entrepreneurs? And then from Imal, I would like to know from an entrepreneur standpoint, how do you work with the investor? I think, this discussion, something that we've all heard is that the investors are also part of the journey. A lot of the entrepreneurs that we speak to tend to think that, okay, give me your money and then, I'll try to take this on my own. So how do you engage with the investors and the VCs and your angel investors to help you charter that path? So first of all, Rishi.
Okay. Hey, no, the great question. Look, there is no rocket science to this. This is, I think, the number one thing that I suggest for all entrepreneurs, but more so for early stage entrepreneurs, is being relentless. And being relentless means that you have to expect that when you are an entrepreneur, you are actually an outlier. Okay. Not everybody is made for entrepreneurship. Not everybody succeeds in entrepreneurship. The ones who succeed are actually the ones who are relentless. So see, oftentimes when we see, so today, Imal is a successful serial entrepreneur. Actually, he's not only had one business, he has a couple of businesses. But if you sit down over a drink and have a chat with Imal, the number of years he has spent and the number of sleepless nights, the number of hours on an airplane, amount of time he has spent talking to customers, investors, hiring great people, it's a very tough job. So you have to be prepared for that. There is no such thing as, I'll go make a nice deck, make a presentation, maybe I'll convince somebody to give me money and things will start. I always tell entrepreneurs that, your real work starts after somebody gives you the money. It's even harder then, because now you have to make that money show some returns, which is execution. And execution needs relentless. So the number one point is relentless. Number 2 point is, at the end of the day, you've got to also have the mindset of an entrepreneur. And I think Imal gave a very good example, right? I mean, he talked about how he thinks the negotiation process, how he thinks about, how am I going to grow the company? I want to make the company a global company. So you need to be ambitious, right? So being relentless is one thing, but if you're not ambitious, you're not looking to really, hit the ball out of the park, as they say. The chances are that that you may or you may not succeed. So take big bold goals. It's okay. Only dreamers can achieve what nobody else has achieved, right? If you don't dream big, you really can't achieve it. And the third point, which is very, very important, is that fail quickly and then learn from it and move on. Failure is a part of entrepreneurship. Failure is a bigger part of early stage startups. No startup today, even the biggest ones in the world, even including the worlds like Microsoft and Google and Facebook and others, at many times of their life, they had near death moments. So I can tell you out of my experience in the last close to 10 years that I've been an investor, and I have founded companies myself. Almost every company I've been associated with, there have been some near death moments, including Nsinga, as Imal might remember, right? Where you feel, oh my God, I'm running out of cash. I'm not selling fast enough. My product is not scaling up. Will this survive? And that is the time when, you've got to have, I talked about relentless, but you also got to embrace and sit down and say, what is it? Why am I failing and what can I change? So embrace failure and quickly, fail quickly, learn from it and tweak and move on. I remember when Imal launched in India, when he came to India for his first trip to sell here. And by the way, guys, in India, nobody pays money for anything. Okay. So it's very difficult market to sell. And it was tough. But he kind of found a way around selling, and that's one of the reasons that he was successful in finally exiting the company. So being relentless, thinking big, dreaming big, and 3, failing fast and learning and moving on. So those are my 3 things that I would, very much want to leave behind with all our founders in Sri Lanka.
Brilliant, fantastic. Thank you so much, Rishi, for taking the time off. And I would like to wish you a speedy recovery as well. Hopefully we'll see you back in sunny Sri Lanka in the near future.
Very soon, very soon. Thank you so much, Charandan, and all the best to everybody for for this wonderful. I mean, Venture Engine is something I've been part of for more than 6-7 years myself, and it's now we've been doing it online, so it's not as fun as it used to be. But hopefully we'll get back to the real thing soon enough. But all the best to everybody, and hey, thanks a ton, Imal. Thanks Shashwat, Kishan, and Shubham, and as well as Charinda for having me over. Thank you very much.
Brilliant. Thank you.
Thanks,
Take care. Bye-bye.
Bye.
Take care.
Imal, over to you.
Yeah, so I think Rishi touched upon. Can you guys hear me?
Yes.
Okay, so Rishi touched upon being ambitious and being relentless, right? So from our side, we always wanted to build a world-class product, and we wanted that to be the best MES for apparel in the world. And right from the day one, we've been telling that. When you say that, it puts pressure on you to make it happen, right? That's your credibility at stake. So being ambitious, if you are in the game, be there for a big game, right? And then the challenges question on investor-entrepreneur relationship. I can give you classic examples and many stories, probably not in this forum, but the mindset, understand the mindset. Like Kishan helped me a lot and spend a lot of time with me to also tell me how the story on that side. So I started realizing as I mature, because when an investor put money on you, he wants to make sure that that money is being well spent, and that money is being put to good use, right? Because as VCs, it's not their personal money. They are responsible for some other people's money, right? So it's their responsibility. That's why they will come up with this extra kind of regulation, compliance. And then on the other side, as an entrepreneur, why you started a company? Because you don't like that working for someone, being in corporate, being in commit calls and all that corporate bullshit. So then when you raise money from an investor, you kind of come back to kind of that kind of scenario again, because now again you're answerable, right? So you feel like what the hell, right? So now this guy is on my back. So that's your feeling. And the feeling on the investor side is that, will this guy spend that money properly, or is he that kind of extravagant type where I've seen a lot of entrepreneurs, like they raise money for fun, and they celebrate raising money, this billion, that billion, and then spend. Guys, when you take money from someone else, you need to have a great responsibility, right? Because and that should drive you to deliver well. So it should not be like you use that money to your own comfort. So you have a great responsibility, but once you build that comfort with the investor, he also realized, no, this guy is not that. Then he start easing off. And also you also start building relationship. You start realizing, no, these guys are coming to help. It's my interest as well, their interest. But there's this period, right, that trust going to be built. So it's going to be tough, right? So understand that their side of the story and your side of the story.
We've had a few sort of, unneeded to be mentioned sort of events, right, Imal? Yeah, I mean, so I think those, so guys, I think what Imal is also trying to say is, not everything is going to be a bed of roses, everything is not going to be a straight road, right? There'll be some curves, right? But all this, I think the investor founder relationship is very important, because there are checks and balances that will hold on to both sides, right? I think it's very important. I think that's what also what Imal is trying to say. I think sometimes when you think from an entrepreneur side, you may think, oh, why is the investor asking all of this stuff?
But then, like as he very clearly pointed out, you just put yourself on the other side, and then you realize, okay, these are probably why these investors are asking for. There is a reason, and those checks and balances will actually help you sort of mitigate some of the risks. Otherwise, you may be able to mitigate risk of those such risks. Sorry,
Yeah.
I sort of butted in because I want to just mention.
No, that's the so the point to the entrepreneurs is you have taken someone else's money, so you have to have that, treat it as your own money, right? So treat it as that's your own hard-earned money, and it doesn't mean that because you have to take risk, you have worked hard and you have spent that money wisely, and still things can go wrong. That's fine, you have to have that risk, and investors putting money knowing that it's going to be lost, but it's not going to be wasted, right? It's like you have tried, you have put 24/7 effort, but it hadn't worked. That's fine, that can happen. Sometimes it's good timing as well. You have tried the best you can. Now you may be, as an entrepreneur, like as a corporate employee, you may be working on 8 to 5 or weekends off and all that. As an entrepreneur, you are 24/7, right? If you're not ready, don't take other people's money seriously, right? It's not fun. You can have your fun. I had my fun, right? So I'm also fun-loving guy, but my mind always works on that, because your mind has to be 24/7 on that. You may be sitting on the beach, but you are still thinking about, or you are still on the ball on customer issue or whatever, right? So that's the kind of mindset you need to have as an entrepreneur. If you are not that, I think you're not going to make the cut, right? So because what you hear on the papers is, wow, this valuation, they raise this much money, valuation goes, skyrocketed, and this guy exited. You hear all the good stories, right? But the bad stories doesn't come in the press, so in media, nobody talks about it. So that's the message that I have to give. So you're taking someone else's hard-earned money for a good cause, so put it use for a good cause and be responsible for that. That's the only thing I have to say.
Thank you so much, Hima, for taking the time. I know you're at an offsite with your team as well. So thank you for joining this session and sharing your insights and spending time with us. Thank you so much. Take care. And we will have a sync up next week as well.
Thanks, Kishan and Chalinder.
Thanks, Hima. Thanks again.
Yes. Bye-bye.
Thanks, Ashwat.
Thank you.
Thanks, Shubham.
Ashwat, over to you. Sorry, we've been
no worries at all.
We've been stealing your thunder every now and then, but
no.
Yours.
I'm loving this. I'm loving this format. So
brilliant. Go ahead. You can share your screens again.
I can. Let me just. I wanted to cover a couple of slides at best. Yeah. So if you guys can see the screen, I was just mulling over some of the companies, right? If Sri Lanka, Virtusa, this is one of the old 95, 96 vintage company, which really brought Sri Lankan software to the world. Millennium IT, all you guys are familiar with that. London Stock Exchange uses them. It's kind of an owner also now. Nsinga came out of Sri Lanka, went to the world. So many different factories are getting benefited by Sri Lankan software for the world. Kapruka, Pickme, these are the kind of people who are fighting regional giants. Kapruka is head on with the Daras in terms of the e-commerce market in Sri Lanka. Pickme is fighting with Uber, which is a global giant, and yet performing well. LOLC, is a company which is a financial services company, one of the largest microcredit company out of Sri Lanka, which was so successful that I actually stepped out of its borders. It built a subsidiary in Myanmar. It built a subsidiary in Cambodia, made a fantastic exit in Cambodia as well. So, in Sri Lanka, and this is just a very small subset of the action which has happened. This is just the top of the mind recall while we were talking I was just jotting these down. So when you are building these startups, if you look at the big picture, and venture capital investors do look at that big picture, that what are you building? What are you building? A very differentiated product out of Sri Lanka for the world? Are you building something which is going to compete, which is going to be so solid that it can compete with tested kind of regional players? Like the second bucket here, Kapruka and Pikmi. These are two companies which are homegrown. They have been competing with global startups or regional startups, and yet they are holding their ground. These are all companies you need to be very proud of, and you need to look at their stories very carefully on how they went about building their teams, how they identified their target customer segment, what are the learnings that you can derive from them. LOLC is another one which is very low key kind of a company, but again, fantastic demonstration. So how they drew their talent, where they garnered the resources at what point of time, knowing those founders, getting connected. Sri Lanka is a very tight knit, closed, small kind of ecosystem. So if you make some effort, you will be able to reach out to people who have been part of these journeys. And if you are able to rope in talent from some of these companies also, they will bring great value because they've seen the formation of scale over a period of time. So the only reason I wanted to bring this forward is because there's so much action which has been happening, right? And different startups have brought different things on the table, and ruthless, relentless execution have made them, scale beyond imagination. When they started, they would have been just a small startup, similar to the ones that you guys are running. But ambition, ruthless execution, the right kind of tactical decisions that they would have taken in their journeys, all those things will be super helpful for you guys to absorb and take your journeys forward. I think, instead of
sorry, Shashwat, one more thing on that previous slide.
Yeah.
I also want to add a company called WSO2.
WSO2,
right?
Yeah.
Started 15 years ago.
Yeah.
They just raised a $90 or $100 million round from Goldman Sachs
Right.
at a $500 million valuation, right?
Right.
This potentially could be the first unicorn out of Sri Lanka. We are thinking this could be the first unicorn that will come out of Sri Lanka. I mean, this is a company that was started, 15 years ago, literally. I mean, went from 0 to 500 million in 15 years. So,
absolutely.
So as you pointed out, I think there's a lot of stuff happening in the ecosystem.
Yeah.
And I think we are only seeing this largely in the tech, and like you said, you have to be relentless. I mean, that's the only way that you keep pushing, right?
Absolutely. Oh, that's a very valid addition. So lots of examples, all based out of Colombo and within a few kilometers of where you guys are right now. So lots to learn from there. Good to form networks. As an entrepreneur, you need to be very well networked, because people like Imal, if they are your sounding boards in your journey, you can't have it better, because these guys have really gone through those journeys. They have seen the ups and downs. They know how to navigate. So please have mentors. Please have your sounding boards in place. That will go a long way beyond capital in making sure that your journey is that much more smooth. As it is, startup is a very difficult activity. The more support you get, the better it is. Now, this was just harping on this slide is harping on the point that you guys, if you want to raise capital from a venture capital investor, the role of growth is very, very phenomenal. So this one takes an example that 3 companies which start at a $1 million revenue mark, if their growth rates differ, the valuation will be so starkly different. A company which just grows from 1 million base at a 25% per annum kind of a growth rate reaches only 3.8 million in year 6, versus a company which grows at 100% grows to 64 million. The difference in valuation 6 years down the line will be phenomenal, because the multiplier that this company will command, the company which has grown at a 100% growth rate, will be higher, and the multiplier will be significantly lower for the company which grew at 25%, because the investor who is coming at that point of time is going to look at the historical performance and will attribute a revenue multiple on the basis of actual demonstration. So A, you will have a higher base of 64 million versus 3.8 million, and you will have a higher revenue multiplier. So a company with both companies which started at $1 million kind of revenue mark will end up at a valuation range of 8 million all the way to 380 million. So this just emphasizes that, a company which is not able to grow cannot generally speaking, for most sectors, it is not able to create value for the VCs. So VCs are extremely hesitant of companies where they don't get a very solid sort of grounding for the kind of growth rates which are possible through those business models. And hence VCs will try asking you, they will try to grill on various different risks related to business model and try to establish that come what may, this company is touted to grow at 50% a year or 100% a year. Under even a very conservative set of macro environment, it is possible. So this slide is just emphasizing on the point that if you are raising VC capital, you need to have a very definitive plan of very high growth in revenues, because if that doesn't happen, then the whole enterprise valuation play is so starkly different that there will be a significant value restriction for a VC as well as yourself as an entrepreneur. So valuation, as I think Rishi also covered, and partly Imal also covered in the past, drivers of valuation, you need to have traction, you need to have projections which demonstrate scale. The projections need to be backed by traction. So for example, if you're projecting that you have 50,000 clients in a year time frame, you need to have demonstrated at least 3,000, 4,000 clients with a certain customer acquisition cost. Then a VC will be able to relate to it very simply that, okay, if I give them a capital at the same customer acquisition cost, I can see that this startup will grow from 3,000 customers to 50,000 customers, provided they have so much resources. Funding requirement, how much is the funding requirement of the business model? VC also tries to make sure that whatever funding the VC is providing, it will last you for at least 12 to 18 months, so that you can relentlessly focus on execution and not be continuously involved in a fundraising cycle. Fundraising is generally a very involved activity. It absorbs a lot of bandwidth. So VCs try to make sure that they give you a runway so that your business model execution can go on for 9 to 12 months before you hit the market for the next round of fundraise. Comparables. So comparables, typically, if you are a very early stage startup, the comparables will start kicking in for your next round. So the VC will try to estimate how large will you be by the time you reach your next round. And on that, 2 years down the line or 2.5 years down the line, what will your likely valuation be? So what is my safe entry valuation right now, so that I will have some kind of an upside between this round and next round. They also look at potential exit multiple, 5-6 years down the line, how large this company is expected to be. Even in a worst case scenario, this company will clock XYZ kind of revenues. Then what is the kind of valuation that is expected in 5-6 years? And they try to triangulate that, how much money, how much valuation can I pay the company today, so that I can make that 4-5x at the minimum in 4-5 years. The example that I talked about earlier. The other thing that they try to do is they try to look at the entrepreneur stake. We want to keep you incentivized. Let's say our math suggests that we need to buy 90% of your company. We'll never do that, because if we own 90% of your company, you own only 10%, then you will not be incentivized to work as an entrepreneur. So that also comes in play. How much is the entrepreneur stake? And VCs try to find some solutions around it. For example, they will give you some kind of a ESOP plan. They will say that if you meet certain milestones, you will get some sweat equity from the company, so that your stake keeps on, becoming meaningful, and you are motivated enough to create value for the company. And finally, the execution risk. If it's a very unknown territory, nobody has done it anywhere, then VCs try to take a very deep discount to your business plan. If people have done it elsewhere, you have also demonstrated to a certain level, the discount between your projection numbers and what the VCs are doing the underwriting on the basis of will not be that much. So it's all a process of iteration. You present a plan, you demand a valuation, then the VCs assess it, and VCs try to operate and do some scenario analysis and try to understand what is my entry price at which I can safely say that I will make that 4x to 5x. I mean, that is the broad math that works. The basics are pre-money valuation and post-money valuation. So if I give you $2 million at say $8 million kind of a pre-money, then the post-money valuation of the company becomes $10 million. And so this is just a technicality. For you, that 8 million figure becomes important because you say that, okay, before the money is coming in my company, the company is getting valued at $8 million. The VC is putting in $2 million, taking 20% stake in my company. This is just a terminology you need to be familiar with so that there is no confusion. When the VC says, I will offer you $8 million of pre-money valuation, you need to understand that this 8 million is before the money is actually coming in. And if the VC is infusing 2, that means the final company valuation will become 8 million of pre-money plus 2 million of actual money infused, which is equal to $10 million. And as I said, investor stake is just, the money which is infused divided by the final total enterprise value or post money value, which is 10 million. So this is 20%. So these are just some terms you need to be familiar with, but on the drivers part, your homework is very important. What is the homework that you have done? What kind of traction you are demonstrating? How do you back your projections? Those are some elements you need to be very, careful about. And the other thing, guys, generally speaking, it is important to not confuse the investor. I mean, if you are, let's say, a product company catering to a client, you need to know what your CAC is. You need to know what your customer acquisition cost is, and you need to know what the lifetime value of that customer is. If you negotiate on the basis of these 2-3 metrics, then the discussion is that much easier. If you don't do that, then it will be, if you try to integrate multiple variables in the discussion becomes extremely confusing. So whichever startup you are in, try to identify only the 2-3 headline metrics and negotiate on the basis of that and keep it very simple. Do not make very complicated financial projections. It doesn't lead to any benefit. Ultimately, the VC also is trying to simplify. In their mind, they will also like to simplify it. They will like to know only the headline 2-3 metrics, which are going to determine the destiny of that startup. So when you are having these negotiations, please try to keep those headline 2-3 metrics which are most relevant for you. Why your projections can potentially work. You need to have a very solid, cogent argument behind it. How large the market opportunity was, what is your demonstration, and how do I extrapolate? If you have got 3,000 customers under your belt spending, say, $15,000, then you are operating at a $5 kind of a CAC. Can I extrapolate the same $5 for the 3,000 to 20,000 journey? What is the evidence that you can produce for that? I mean, these are the kind of things you need to internalize when you are having those negotiations, because your projections will also form an important basis for the valuation exercise which will be undertaken. Any questions on this? Otherwise, we are largely done. And I think I can open it for questions.
Guys, before we go to the next round of evaluations, this is a very important session as well on valuation, because your next venture engine valuations will largely focus on, your fundraising, your growth, what are your key KPIs that you're trying to achieve, and the outcome of that is also the valuation. So make sure you send in your questions and we can clarify all of those as well. Okay, Shashwat, I have a question. This is from an early stage company standpoint. Let's say, you build a product, it's a B2B company, and you initially only have a, slightly, traction is not great, but it's enough to say that there is potential in the market. In that kind of situation, how would you go about the whole valuation exercise, especially if you're trying to do like a, seed round, where you're looking to raise about $100,000, $150,000. And how would you, what tips would you give for an entrepreneur
Right, right. So I think, see, generally the 100K round is typically done by angel investors. VCs typically will do upwards of 500K, but broadly speaking, the angel investor, how the angel investor will really think is, first of all, you will have to discover that angel investor will understand that problem well. For example, if let's say you are serving garments industry, there are several high net worth individuals who come from the garment industry. If you are able to identify a pool of angel investors who can relate to that problem and can vet that really this product can make a difference to the garment industry, that will be super helpful because they will understand that value proposition. Without the demonstration also they can understand and relate to the problem. So first is discovering who your potential partner can be under those circumstances, because you have to also think about uh, what are my chances of conversion, right? So if you go to someone who is a VC with a very limited demonstration, then the chances of conversion will be that much lower. And even if that gets converted, the valuation will not be palatable. It will probably be very, very conservative valuation, because the VC will say that unless you demonstrate, I can't give you value, right? So that is typically the challenge around such things. So that's why our advice generally is that if you are raising 100K round, you have very limited traction, you go to people who know and who can understand the value of your product better, so that their inclination to value and their inclination to actually convert that funding round will be that much higher. And generally speaking, angel investors prefer to stay in the 10-15% dilution range at the max, because they understand that the entrepreneur has to raise successive rounds of funding. So they will operate in that 5, 10, 15% kind of range. The VC will then come in and the VC will operate in a 20-30% kind of a range. So the ranges are also not very ad hoc. You will rarely see an angel investor coming in and taking 40-50% of your company. And if that happens, it's not a good thing. If you dilute 40-50% straight away, you will have very limited room to raise funds down the line. VCs will see that very adversely, because then they will question whether it is your company or the angel investors' company.
Got it. Thank you so much. Kishan, I believe you have a question.
Yeah, I mean, I wanted to ask, this is just to sort of give a little bit more conceptualize some of these terms that gets used in the investment space. Shashwat, can you also explain, what VCs, when they say, cap table, right? They talk about cap table all the time.
Yeah.
I know many of our founders may not know what exactly a cap table is.
Sure.
So I think if you want to just a quick sort of brief explanation, I'll add in probably after you.
Sure. So cap table, guys. So see, when you are an early stage founder, what the VCs try and understand is what is the existing capital structure of the company. So what we have seen is that, let's say it's a 3-founder team. They say, let's split 33 amongst ourselves and start the company. And when the VC comes in, the VC takes certain stake. Let's say 20% stake is taken by the VC. Then all the existing shareholders, which are these 3 founders, they get diluted by 20% each. So then the cap table gets revised. The cap table has the 3 founders and the VC. And then there is another component which a VC tries to create for incentivizing some key employees, which is called ESOP, which is employee stock option pool. The employee stock option pool is a very vital component in incentivizing staff to get remunerated for their good performance. You would have heard several stories that the Flipkart sale or delivery sale. I mean, there are so many millionaires getting created in India who are not founders. These are all key employees at startups who went on to do well, and their efforts got recognized when these employees were getting ESOPs. So when the VC is actually structuring the deal, the VC also tries to identify how much of a talent pool gap is there and how much share of the company should be reserved for the key staff who will be joining this company or who are already part of this company, basis certain milestones and certain amount of time that these key employees spend in these companies. The people working for these companies are awarded some stock options as well. So typically in an early stage startup, these are the three components you will see: the founder's share, the VC's share, as well as the employee stock option pool. And then over time, as more and more rounds happen, more and more investors and stock option pools also keep going up and down. But ideally, when you are negotiating, you should keep that in mind that, you know, if it's a cap table, if it's a capital structure in which only the founders have equity, you should try and see how to create provision for key employees so that they are also equally incentivized and excited in contributing to value creation in your company. So that's my take. Kishan, you wanted to add something further?
Yeah, so I think the only thing I want to add to what you just said, Shashwat, is I suppose when you have an up round or a down round, I mean, your cap table and the valuation obviously either gets diluted or there'll be an accretion, right? So down round meaning, guys, when you have a round, your future round, which is valued less than your previous round, right? So which means you get diluted more than what you should. But investors will have an anti-dilution clause,
Exactly.
which will allow them to sort of get bumped up to their equity, so that they don't lose because the company had a down round. Then there is what's called an up round, which is what all companies strive for. They'll continue to do up rounds as they go on. As they start progressing, the risk starts coming down. Usually you want to get into up rounds. I mean, that's where wealth gets created, right? So up round is the exact opposite of the down round. You get diluted less, and the company gets valued higher and higher. There is also flat rounds, where there's no change in valuation. But you would still sometimes, founders end up in a situation where they don't have money, and probably your existing investors may put more money into the company at a flat round. Very rarely happens. I haven't really seen a flat round happening in my life. I don't know if you have seen, Shashwat, but it's usually an up round or a down round that usually happens.
Yeah, typically it is the up round or a down round scenario. So this example that you see on slide is capturing that: a company which got valued at $20 million and it didn't perform to the expectation, and it went into a situation where it had no choice but to accept a lower valuation. So 20 million was the entry price for the VC, and 4 years down the line they got $15 million kind of a pre-money valuation. Then VCs try to seek protection. So they will say that, hey, I gave you 20 million with the expectation that you will continue raising up rounds. So 20 should be followed by at least 30, 35, then ultimately exit at say 80, 90, 100. I mean, that's the trajectory that the VC has charted out when they are underwriting the case. But in terms of in reality, the performance didn't really match the expectations, and you were left with no choice but to do a down round of $15 million pre-money compared to 20 million of the first round. Then the VCs protect themselves. They say, hey, you will have to restate my shareholding so that my entry price becomes $15 million. And what that leads to is the founder gets significantly diluted, because the entire dilution has to be borne by the founders and the ESOP pools, which are reserved for the company. So this is one example. So that's the pitfall of taking very aggressive valuation, because what VC will say, okay, nothing doing, I love your startup, you are just not accepting my proposition, then take this valuation, but take this with anti-dilution. Anti-dilution will definitely be there. If you take a very high round with anti-dilution, one down round can bring your stake significantly down. So 3-4 years later, you will be in a very, very bad situation, even though you started off with something about which you can be very emphatic about, that you negotiated a very high valuation. So that's why it has to be balanced. That is where the balance needs to be there, that the trajectory of the valuation needs to have a strong correlation with what you have actually demonstrated. If it is out of the whack in either direction, if it is too low or too high, both have their own challenges. So this kind of brings that point forward.
Brilliant.
Yeah, and also it's very hard.
Hold on a minute. There's a question. We'll put that question. There's been for a while. Tarindu, go ahead, Tarindu.
Hi, thanks, Chalinder. Shashwat, just one question from me. So now we discussed sort of like funding rounds, like seed funding, Series A, Series B, for example. So for a startup, can you just let me know like what should be the funding, like the funding goal at each round? Like for seed funding, is it like, let's say, building that minimum market viable product? And Series A, what should be the goal like of the for the startup?
Right. So actually, if you see this chart, it kind of, covers what you're asking. So, the first journey, as you mentioned, is to reach that MVP. That's where, the bootstrap and the family funds come in the picture. That's the absolute seed round. The moment you tap in angel investment and venture capital, you should ideally move from MVP stage to a more scale up stage. Even in this scale up stage, chances are you will probably not be financially profitable, but the unit economics will start settling in. When you reach the private equity segment, by that time you will be EBITDA positive. You will be, financially you will start generating return on equity. So these are different phases, and that is how people typically imagine it. Uh, Now, in this, everybody, it's not it's not to say that exceptions will not arise, but generally speaking, to reach the MVP, you raise the seed round. From MVP to the next phase of getting to X number of clients is the venture capital and angel investment rounds role, and from reaching the X number of clients to the financial viability is the next set of investors who come in your journey. Depending on the business model that you are running, how much of a cash burn you have, the amounts will definitely vary, because some models are extremely cash prudent models. For example, if there is a enterprise tech kind of a firm, chances are their burn is significantly lower because they run their operations in a very lean format. They expand their sales team only as and when required. Compared to that, if you look at a B2C e-commerce vertical, the B2C e-commerce company has to do marketing, they have to do market making, they have to create awareness in consumers. So the first 3-4 years are very hyper burn years for a horizontal B2C e-commerce company. So the amount of capital the B2C e-commerce company has to raise even at the Series A stage will be much higher than a B2B enterprise tech startup. So it will all depend on a case to case basis as per the requirement of the business plan. The investors generally have an understanding of what kind of capital requirement will potentially work for you, depending on their past experiences as well. But you need to have your homework ready, and you need to know the more capital you are trying to raise, you will obviously have to have dilution in your mind, that you at early stage, if you're raising a lot of capital, you will get diluted as well.
Okay. Shashwat, just one more question. So when we are, let's say, trying to do a valuation at seed stage, so what should be ideally the time frame we should look at? Like, let's say, is it next 3 years? This is where I want to be, and then based on that, let's say, number of users, we do the valuation.
So see, frankly, seed stage, what I've seen in India is a very range bound discussion, as I mentioned, right? People who are backing you know you in some sense, or know your sector in some sense, and they take more a stake approach than a valuation approach. So they will probably look at your venture and say that if we come together and we give a seed check to this company will have a 12-month runway and will achieve XYZ milestones, and chances of it raising capital at say $10 million pre-money or $15 million pre-money is reasonably high. And accordingly, they will calculate and they will see that, okay, if I as an angel investor get in at $3-4 million kind of post money, then I will have a reasonable chance of making a 2x to 2.5x in a 1 to 2 year kind of time frame. So thought process remains very similar in some sense, but that is invariably how people will like to look at it.
Okay, got it. Thanks, Shashwat.
But very early stage startup guys, rarely you will find an investor looking at your last 12-month revenue and applying multiplier. Very early stage, it won't make any sense actually. The revenue multiplier starts happening only when you have crossed a certain sort of benchmark. Backward looking revenue multiplier.
Any other questions from anyone?
Shahid, go ahead.
Thank you, Chalinder. So, Shashwat, thank you for the presentation that you did today. I just have one question on the revenue multiple thing. Is there any term that VCs follow when, or depending on the stage or type of business, on how they differ? Is there any rule of thumb on revenue multiple for valuations? And does it differ from like product
it differs
companies
actually.
and service-based companies?
Yeah, so it differs. I'll tell you, different people have different mental model of thinking about it. But you know, prima facie, what I have seen, consumer tech startups who are able to get say 70-80%, 100% kind of annual growth, they are in India at least, they are able to command a value of 3x to 5x kind of sales zone. Enterprise tech startups who are very profitable, you know, every client, the CAC to LTV is very significant. They are able to command anywhere in the 7 to 10x range as well. But if you're looking at the commodity end of things, let's say you're talking about a consumer company which makes biscuits or let's say milk, those kind of things, where things are very range bound in terms of margins, as well as the growth rates are not astronomical because they are not tech driven ventures, they are non-tech ventures. So non-tech ventures can have, you know, valuations as low as 1 to 2x as well of sales. So it straddles, there is a full continuum of, you know, startups of certain nature, non-tech kind of startups who are able to get 1x, 1.5x also, to all the way to enterprise tech startups who are able to command in excess of 10x also, depending on, you know, what vertical, what is the level of competition and so on. That's how, and these multiples are typically applied on more scaled up startups who are at least, you know, top 3, top 5, top 10 in their respective verticals. And early stage startups in the same verticals try to use them as some kind of comparables for them when they reach that point.
Great. Himesh?
Thank you.
Hi, Chalendra. Hi, Shashwat. I have actually quite a few questions. Let me take at least a few of them. First, Shashwat is on. You can hear me, right?
Yeah, I can.
Yeah. Valuation. How the valuation is carried on. I heard you saying the seed investors might look at what the exit valuation might be. So, what is the valuation for me to come in so that I can make a return 2-3 years down the line? So are you saying at seed angelism investment level, there's no point in looking at discounted cash flows and PEs? No, that's not an approach to look at a value?
Yeah, I mean, frankly, DCF is for very mature companies because the number of variables are so high. When you're forecasting as a very early stage entrepreneur, your projections can go so haywire that people don't employ DCF as a practice. But projections are very important. Projections will be heavily debated. People will ask you what is the grounding that you have. If you said that you will make $2 million in 2 years, what makes you confident? What demonstration have you done? So there'll be a huge debate on your near-term projections, especially next couple of years, next 2-3 years, and basis whatever, you know, whatever is a consensus between investor and the founder, the investor will then do a back of the envelope calculation that on a conservative basis, this company is touted to reach X scale, which means Y valuation, and then try to back calculate. So early stage, this is how typically things are done. DCF is not really useful.
Okay.
And
Also,
do not
just to
fall
add
into
on, yeah.
yeah, do not
Just
fall
to-
into getting valuation done from Big Four and all that. Then nothing of that sort is going to help you.
Yeah, just to add on projections, like obviously as Shashwat mentioned, while we won't take your projections on face value, we'll obviously do a deep dive on it. It's also very important to be sort of ambitious with your value, projections, because if you don't really see ambition in your projections, in the kind of revenue you can reach, it sort of makes it a non-VC model, because like if you can't really project decent growth rates, we see sort of lower exit projections for us. From that perspective, that balance is really required in terms of what kind of revenue growth you're projecting over the 5-7 year time period.
Thanks, Shubham. So you mean to say, but those ambitious projections need to still be rational and backed up?
Definitely.
Mhm. So there cannot be gaps in the rationale, right?
Definitely, yes. Obviously, rationality is definitely important, but yeah, at the same time, we've seen companies project sort of 15-20% growth rate year on year, and come for VC funding. So from that perspective, that makes it a tough choice for us as well.
Right. Okay. Great. So my second question again to
There's another question. Let's just give the person the opportunity, and then we'll come back. Yeah.
Okay.
Camila, go ahead.
Yeah, this is regarding dilution and ownership. So from your perspective, at which point should the founders give up the 51% when you're raising funds?
That's a pretty tricky question. See, 51%, even if it becomes even if you give up 51% and you have multiple parties taking the 49%, or I mean, multiple parties taking the 51%, you're not necessarily relinquishing control. Depends on how your cap table looks like. If you are able to successfully diversify your cap table and you have multiple set of investors, then relinquishing 51% control is not a big issue. But if there is only one single party who is putting in money in your company repeatedly and they cross the 51% threshold, that is a big deal. So you need to be mindful.
No stage involvement there. It's literally about who you have and like the composition.
So stage, Camila, as I mentioned, try and limit your dilution to under 15% at the seed stage. Then subsequently, when the venture capital investor comes, try and limit your dilution to further dilution to another 20-25%. And then after that, most likely, if you have crossed that threshold and you have performed after that, the subsequent rounds again come down to as low as 10-15% dilution as well. So the first couple of rounds, you need to be very mindful that never dilute 40% at seed stage. That will give you a very bad starting point.
Yes, got it. Thank you very much.
Himesh, back to you.
Thanks, Shalendra. So my second one is around actually, Avishka, again, because you're in the impact space, Shashwat and Shubham. You spoke about that you consider that into the criteria, but how is that built into the valuation? Is it all what you talked so far revolves around ROI, IRR, and nowhere in the equation does impact really come into the valuation?
So impact, Himesh, is more of a filter for us. We will not support businesses if they are not high impact businesses, because that is a mandate that we have undertaken. So we stand for a certain reason and we try to stick to that. So hence our filter is slightly further narrow, because we will not look at business models which are not necessarily high impact business models. But once that filter is crossed, the evaluation is just like any other venture capital investor, because our return objective is same. So just because we are impact investor, we haven't taken a lower kind of a return undertaking. Return undertaking is same as any other tech investor.
Right. So the nature of the problem you're solving is really not really relevant.
Yeah. I mean, we have invested in dairy, we have invested in waste management companies, and they have yielded 40-50% IRR for us. So we have demonstrated that if you are carefully selecting the entrepreneur, even for solving an impact problem, you can make very hefty returns. So that's been our thesis, and that's why we are super selective about what we do in the impact space.
Okay, okay, brilliant. Chalinda, can I go into my next question?
Yeah, go ahead, go ahead.
Yeah.
I don't see any other hands.
On the cap table, at a seed stage, is it very important for us to have a good idea on what the cap table outlook would be in the 5-6 years to come? Is that important?
I think it's too far out, Himesh. Very difficult to predict. You will have to tide it round by round. By round, you have to. That's why I said that when you are approaching a VC, say seed round, you will probably just have some angels coming on board. But the moment you have VC rounds coming in and you're trying to build an organization, at that time you should start thinking of things like employee stock option pools, because ultimately what will make you from a proprietorship to an organization is these employees who will come and dedicate their lives to your mission, right? So those are elements that you should think about, but round by round you need to think about it. You can't be too long term in that, because who knows 3 years later who will come.
Yeah, sure.
So
my last.
Sorry, hold on, Himesh. Michelle, go ahead.
Hi, I have a question on this dilution. Let's say during the seed investment that we have diluted about 40% of the company. So how can we recover from this? What strategy that we can adapt to like correct that error and to go for another round of funding where we don't lose the 51%? The founder doesn't lose the 51%.
There are two ways to do it.
Sure.
Both of them are a little difficult to implement, but what I have seen from my personal experience, one way is that when the next investor is coming, you try to negotiate a promoter stock option pool and try to catch on to some of the equity that you have lost. So you try to prevent your dilution. You negotiate and you say that you have already sort of diluted 40%. Can I get a 5% kind of a stock option pool for future, which you can award me on basis of certain milestones. But if that gets awarded to you, then your stake will continue to rise. That is the method number one, that you create a promoter stock option kind of a pool. Second method is generally what I've seen is that people try to, try to arrange funds from their closed networks and try to organize a secondary between the guy who has taken 40% and the person who is in your closed network, and try to get some equity, which is, even though if it's not in your name, but it's a close friend of yours or your your family or someone like that. So that is the other method I've seen, that people try to rebalance the equity shareholding.
Is it possible to agree with a VC who's going to come in and to have an agreement where they buy back the shares from the new, buy back the shares from the existing?
They do it all the time, actually. When VCs realize that there is an angel investor with significant stake sitting in the company, they will make an offer of putting money in the company for shares as well as some secondary shares. They will say that I will like to buy X% of the angel at so and so price, and those secondary negotiations also happen when the VCs come, because VCs also don't like that. Let's say VC is getting 20% kind of stake, and there is an angel investor sitting with 30%, then VCs also don't like that equation, because they would like to see themselves as the largest institutional investor in the company. So they will probably make an offer to that party that why don't you sell 10% to me so that I become the largest institutional shareholder in the company.
Okay,
but that doesn't necessarily solve your problem, because then it's just going from that angel investor to the VC. It doesn't come to you.
Yes, I get that.
Go ahead, Himesh.
This will, Chalinda, I'll have to drop off after this.
Sure.
Just last couple of questions, guys.
Yeah, thank you so much.
Thanks, Sharon, again. So last question for me on the investor mentality on the exits again, Shashwat. So isn't it looked down upon if a new investor is coming in and then existing investor wants to exit. And from the existing investor's point of view, why are you looking to exit when a new investor thinks that they can grow value, and the existing investor thinks I want to cash out? What's the psyche here?
See, you are absolutely right. That's a very valid question. Generally speaking, the investors don't like it that an existing investor is walking away. They like the existing investor to stay back and hopefully put some more money also. I mean, general expectation is that let's say you are out in the market raising $5 million kind of round, then they will expect that why doesn't the existing investor put one and I'll put four? I mean, that's the typical discussion that is done. But having said that, the investors also know each other reasonably well. The one element which comes in the equation is what is the vintage of the fund which has invested. So, for example, if I tell that incoming investor that my fund was a 7-year-old fund, 7-year vintage fund, and I'm already in my 7th year, I have to return the money to my own limited partners, then people understand. So on a circumstantial basis, people understand. Generally speaking, you are right. Generally speaking, the expectation is that existing investors should stay on and ideally should put more money on the table, because that's kind of giving you a certificate that they continue to believe in you.
Absolutely. So that's the entrepreneur. That's what we should look for, is it? That's what we should push for.
That's what you should push for. But the practical challenges you will face are basically, if that investor is running towards the end of the fund life, then that investor also doesn't have a choice. They have to exit.
Correct. Thanks, Shashwat.
All right, Shashwat, thank you so much for taking the time.
Sure.
Join us on Friday. And this has been a fantastic session. Thank you so much to you and Shubham as well. Hopefully we'll see you guys here in Sri Lanka now that the borders are getting relaxed, and hopefully at least Q1, Q2 of next year.
Absolutely.
Thank you once again for joining.
Thank you. Thanks, guys. Lovely interaction, and all the very best to you guys for Bench Engine.
All right. Thank you. Take care.
Thanks,
Bye-bye.
everyone. Thanks.
Thanks, Shashwat. Bye.
Thanks, everyone. Thank you.
Bye. Take care.